If you are a small business owner and you're considering your options for getting rapid funding for your small business through an alternative lender, then you might want to listen to my Torro review. This Torro review will explain the two different types of loans that Torro offers. My name is Gordon Scott. I'm a small business owner who uses alternative lenders. I'm not a licensed credit advisor. This review of Torro is my opinion only. It's sponsored by FinImpact.com, a must-read website for anyone researching alternative lenders. There you can find information about a wide variety of loan types and the companies that provide them. Torro hasn't been in business as long as some alternative lenders, but their unique approach has allowed them to carve out a successful niche as they service their customers. Torro has two classifications of loans that they offer. They offer loans to startups or businesses that are pre-revenue, and separately they offer working capital loans for businesses that have a consistent track record of being successful at bringing revenue and profit. You can imagine that the more obvious industries for the kinds of businesses that Torro is looking for might come from construction, trucking, e-commerce, or restaurants. Anything where you can use capital to purchase goods, improve on them, and sell them for a profit. That's the kind of business that Torro likes to look for. So if you're a business that has a good way of putting capital to work to generate revenue, Torro wants to work with you. Let me give you an example of their application process, which is a little different from other alternative lenders. You apply online by filling out a form that takes less than 30 seconds. When you complete the form, the website will immediately give you a video that has the message, "Hey, we'll call you soon." Or, if you don't want to wait, you can call us. Now, if in fact you do that, make sure that you call them from the same number that you put into the application. That way, they'll immediately connect you and your application and save you some time. Then, over the phone, they'll ask questions like, what kind of business are you in? How long have you been in business? How much revenue do you bring in? How much revenue have you brought in recently? How much are you looking to borrow? Interestingly, they do not ask for your credit or tax ID at this point in the application process. It's a pre-qualifying interview, and it's basic stuff. But because they're doing it over the phone and live, they can zero in on the details that matter most, and that helps them more quickly determine whether you're ready to continue on with the application process. So the response from this conversation will either be a quick rejection or an invitation to continue. If they think they can work with you, they'll send you an email with a link to a more in-depth application. This email will link you to the actual loan application, but because you're pre-qualified, the form still isn't arduous. It can be streamlined to helping you get to what you need. The form does have you make an official request of the range of dollar amounts in which you'd like to borrow, and the application now asks for your tax ID number so they can do a soft credit pull and a hard credit pull if in fact you've been approved for the loan. The pre-qualification application does a soft credit pull. Now, you might not know the difference between a soft or a hard credit pull, so let me give you a quick explanation. A soft credit pull, as explained by thebalance.com, does not affect your credit score. It's actually a mechanism that banks use for pre-qualification. They look over information collected by a third party other than the major rating agencies, and they get an idea of whether or not you're qualified to go ahead and take this loan. Legally, they don't even have to ask permission to do that because, in theory, it's not going to affect your credit score. A hard credit pull is actually going to one of the major reporting agencies. And of course, that will affect your credit score. But it's important to understand that in the pre-qualification, the lender only does a soft credit pull. Now, once you take the loan, that is the equivalent of a hard credit pull as well. Depending on how much of a loan you take and the health of your business, the impact to your credit score will vary. But if you complete the loan and then pay it all the way back, that can actually help improve your credit score a few months later. But just be aware that the process of applying and then taking the loan will have an impact on your credit. The application is pretty streamlined. It shouldn't take more than 10 minutes. You then attach your bank statements as PDFs and sit back and wait to hear from them. The loan amounts can be as small as $10,000 or as large as $500,000. So there's a good range of working capital for businesses and for startups. To qualify for working capital loans, a business should have a credit score of 600, but most of those who actually get approved will be 680 or higher. The business should have a minimum annual revenue of $120,000 and have been in business for at least 6 months. Now, like any aspect of alternative lending, nothing comes without a price tag attached to it. So it's important to understand that alternative lenders like Torro have conveniently available loans that are not cheap. In the long run, the money that you make from these loans might really be worth it for your business, but that's an opportunity you'll have to judge carefully. You'll want to make sure that the revenue you're getting back from having borrowed these loans will be more than enough to make the loan payments. It's important to do your research comparing the opportunity and the cost. The longest term length for working capital loans is just 24 months, and for startups, it's 48 months. The interest rates can vary widely depending on your business and the kind of revenue opportunity you have. The annual rate caps out at about 36%. And you can imagine that a first-time borrower is probably going to be offered a loan somewhere between 25 and 30%. In addition, Torro charges origination fees and monthly maintenance fees. So you'll want to look closely at the terms before you sign up with them. Now, you would think that these additional fees might cause a lot of negative response among customers that put out online reviews. But the ratings from the Better Business Bureau and Trustpilot are actually quite good. Let's take a closer look at the feedback they've received over the years. They have an A+ rating from the Better Business Bureau and a very impressive 4.7 out of 5 rating on Trustpilot. Trustpilot shows that they have over 600 reviews, and 91% of them rate their experience as excellent, or 5 stars. While 5% of the responses, that's about 30 of them, rated Torro as bad, I thought I'd take a closer look at the bad reviews and see exactly if there were any patterns. What I found was that Torro has a bit of customer service work to do. Although these reviews are comparatively few, the theme was that these customers had a bad customer interaction with Torro's agents. 1 or 2 agents getting their job wrong is one thing, but half a dozen separate agents mentioned by name seems a bit unnerving. So be aware that you may run into customer service issues using this company if you don't meet their standards for revenue and consistency. But I should point out that far and away, most customers have an excellent experience with Torro and its agents. Of all the complaints you could have against an alternative lender, simple customer service interactions are actually a rather mild issue. If you want more detail, you can find the full review at finimpact.com.